Hey, how's it going, everybody? My name is Troy Hackett, and today we'll be going over part 5 of the practice prelim number 2, which is short answers and capital budgeting. And the first question I'm not going to go over, it's more of a memorization question, so I don't really know how to explain it that well. So let's look at number 2, which is press which company has budgeted production for the next year as follows. So they give us some production numbers here for each quarter. And additionally, it says 2 pounds of material A are required for each unit produced. The company has a policy of maintaining a stock of material A on hand at the end of each quarter equal to 25% of the next quarter production needs for material A. And this makes sense, right? So like if you're Apple and you're producing iPhones and you show up to year 2023, like January 1st, 2023, some of those phones are already going to be pre-made because Apple doesn't want to show up to 2023 with 0 phones. They're going to have some of those phones pre-made for the next period. But next it says a total of 30,000 pounds of material A are on hand to start the year. Budgeted purchases of material A for the second quarter will be, and they give us a bunch of answer choices. So the first thing I want to do here is I'm going to convert my units into pounds, right? Because our answer is all in pounds. So our first year is 120,000. So I got to write in black here. So 120,000. Second quarter. I might have said first quarter, but so first quarter is 120,000. Second quarter is 160,000. Third quarter is 180,000, and fourth quarter is 140,000. So that is the amount of pounds they got to produce. Instead of looking at a unit standpoint, we converted it into pounds to make it easier for us. So now what I have to do is I need to look here, and they're asking for the production or the purchases for the second quarter. So in the second quarter, so Q2, I am going to add 160,000. So I'm going to first start off with how many pounds we need for the amount of units we're producing, okay? So I need 160,000, but then we also have to buy pounds for the third quarter as well. We pre-buy materials for the following quarter to make sure that that whole situation with Apple I was talking about doesn't occur, where we don't have any iPhones to sell. So for Q3, we need to have 25%. So I'm going to do 180K times 0.25, and then I want to subtract 160K times 0.25. And the reason why I'm subtracting this is because even though we're selling or we're producing 80,000 units, or AKA we gotta have 160,000 pounds, we bought some of those pounds initially in Q1 to prepare for Q2, which is why we're subtracting it now. We don't have to double count it. So when you do that, you get an answer of B, 165,000 pounds. So for part 3, it says the management of an amusement park is considering purchasing a new ride for $80,000 that would have a useful life of 10 years and a salvage value of $10,000. The ride would require annual operating costs of $32,000 throughout its useful life. The company's discount rate is 9%. Management is unsure about how much additional ticket revenue the new ride would generate, particularly since customers pay a flat fee when they enter the park that entitles them to unlimited rides. Hopefully, the presence of the ride would attract new customers. And the question here is, how much additional revenue would the ride have to generate per year to make it an attractive investment? So what I like doing here is making a chart. So I make a chart and I have year 0, I have years 1 through 10, and I have years 10. And this helps simplify our cash flows, and we put our cash flows in respect to the year they belong to. So for example, they say that purchasing this new ride will cost us $80,000. So I'm going to put negative $80,000 in year 0 because that's when we're purchasing the ride. And then I'm going to put $10,000 in year 10 because we know that we have a salvage value of $10,000 after 10 years. So that's why I'm putting positive $10,000 in year number 10. Next, I got to figure out what is the annual operating cost of this ride. And they tell us here that it should be $32,000. So I'm going to write here for years 1 through 10, $32,000. And the reason why I can do this, and I can put $32,000 for years 1 through 10, is that annual operating cost is going to stay the same. It's not going to fluctuate. But for example, let's say the annual operating costs fluctuated between each year. At that point, you have to write year 0, year 1, year 2, year 3, year 4, year 5 to put those cash flows in a respective year. The reason why I could put $32,000 all in just one column is because the annual operating costs are the same for each year. So now what I gotta do is I gotta multiply these by their respective present value number. So the way I do this is I look at a present value chart. So I'm gonna look that up now actually. But you guys should be handed one in class, but if not, you can just like look it up on Google. So I'm gonna look at present value chart in Google Images. And for the year 10, I'm gonna look at just a normal present value chart. And remember, we gotta look at this discount rate. So the discount rate is 10% or 9%. So you have to use that 9% in the chart. So you go to 9% for the rate, and then you go to 10 periods because it's been 10 years. And you multiply this by 0.4221. And for the years 1 through 10, since that's multiple cash flows, it's not just $32,000 for 1 year. This is $32,000 for multiple years. We have to use a present value annuity chart, but we'd be using the same discount rate. So I'm looking here, I'm looking for the number, and I look for 10 periods for a 9% discount rate, and I get 6.42. So you might be wondering why we're only multiplying by 0.42 for the $10,000 and why we're only multiplying by 6 times 32,000, even though the $32,000 was incurred for 10 years. This is because when you're looking in the future, cash flows that are incurred in the future are worth less. And to give a good example of this is, if someone promised me to pay me $100, it'd be worth a lot more now than in 100 years. And this is because if you pay me $100 in 100 years, you know, there's been inflation, I could have put that $100 in treasury bills and made money off of it. So money which is out in the future is worth a lot less. And that's very important to understand. To get back into it, I need to multiply these figures. And the reason why we don't multiply $80,000 by anything is because $80,000 is in the present. We're spending that money right now in the present, so we don't have to discount it towards the present day. So when I multiply these things all out, so I'm gonna multiply 32,000 times 6.42, and I get negative 205,440, and then 10,000 times 0.4221, and I get 4221, and then negative 80K. So I'm gonna add these all up together. So when I add those all up, I get a cost of 281,219. And the question is asking for what additional revenue would the ride have to generate per year to make it an attractive investment? So what I gotta do is find out that annual cash flow they gotta make to make this ride worth it. So basically we gotta at least pay off this investment. That's the minimum we gotta do. So in order to do that, what I'm gonna do is I'm gonna write X times 6.42. And the reason why I just can't divide 281,000 by 10 is because these cash flows are also gonna be made in the future between years 1 through 10, which is why I'm using that same annuity value of 6.42. So I divide that. So 281,219 divided by 6.42, and I get 43,803. So that's how much money we got to make per year to make, at least break even on this ride. So I know that's a little bit complicated. We got to use, X as a variable, which is very uncommon for these types of questions. I don't see that too often. And it's definitely one of the harder questions. So if you can nail this question, number 3, you're looking pretty good. But yeah, I hope you guys enjoyed that video. And we actually have 2 more parts. I just realized we have a part 4 and a part 5. So let's actually do that first. So I'm going to erase my, I don't know what I'm doing. What just happened? So I need to erase this work here, and we got to do part 4. So part 4 says, High Corporation is considering the purchase of a machine that promises to reduce operating costs but the same amount for every year of its 5-year useful life. The machine will cost $205,980 and has no salvage value, and the machine has an 14% internal rate of return. So that 14% is going to be our discount rate. And it says, what are the annual cost savings promised by the machine? So what we got to do here is I'm going to write out my chart again. So I'm going to have year 0, year 1 through 5, and year 5. So there's our chart. And we know that this machine will cost $205,980, so I'm going to make that negative because it's a cost. So the first thing we got to do is we got to write negative $205,000 for year 0 because that's a cost that's incurring in year 0. And when they say that a machine has an internal rate of like a 14% discount rate, that's essentially saying that $205,000, whatever positive cash flows we're receiving should make that cost 0. Okay, so whatever X here is, like whatever this value should be, X, it should make this equal to 0. Okay, so we gotta figure out how to get that. And the first thing we gotta do is we gotta look at our annuity chart again. And I think when I'm editing this video, I'm gonna put an annuity chart in the video so you guys can look at what I'm looking at right now because I'm just looking at it on my desktop. But if I'm looking at the charts here, I'm looking for one which has 14%, so I just found one, and we got to look at 5 years because this is only a 5-year question. Look at 5 years, and it says here that for 5 years at a 5 or 14% discount rate, it's going to be 3.43. So what I'm going to do is negative 205,980 should equal to X times 3.43. We get a grand total of $60,000. So in essence, in order for this machine to generate a 14% return, we must earn $60,000 per year. So that's how you do question number 4. So let's hop right into question number 5. I'm just speeding through this because honestly, I've been recording these videos all day and I kind of just want to shoot myself. I don't know why, but the first couple videos were actually pretty easy to do, and as I've been doing more videos, it gets more and more difficult to record them. I can feel myself. I can feel my teaching skills not being as good. I definitely think my teaching skills in the first 2 questions were a lot better. So I'm just trying to finish question 5 before my teaching gets any worse. But anyways, hopefully this still makes sense. I'm just hoping that it sounds bad to me, but to you guys, it sounds all right. Hopefully you guys can understand it. If not, I'll be very, very sad because I want you guys to learn. But finally, question 5 says, Gallatin Inc. has assembled the estimates shown below relating to a proposed new product. These estimates are based on a 5-year project life, at the end of which the new equipment would be sold, working capital would revert to other uses in the company, and the product would be discontinued. Gallatin uses a discount rate of 10%, and it says, compute the net present value of the new project. Very simple question here. We gotta do we gotta write that chart down. So year 0, years 1 through 5, and year 5. I'm gonna write that chart. And it tells us here that we have an expense of $340,000, but that is an annual expense. I'm actually gonna ignore that at first. But they do tell us here that the initial cost of the equipment is $300K. So that's good. So we can write $300,000 for year 0. That's the initial cost to buy the equipment. And they tell us that the salvage value is $50,000. So we're going to get $50K in year 5. And they also tell us that the working capital requirement is $60K. So I'm going to put negative $60K here. And I'm going to put positive $60K here. And the way of thinking of working capital, it's basically an investment. So you're spending that money initially, but you'll get it back after a few years. It's kind of like when I buy stock. Let's say I buy stock in Alibaba, right? I put $50,000 into Alibaba. That money's not gone. It's just in stock. It's an investment. And eventually when I sell that investment 5 years later, I get my working capital back. Granted, it's not worth as much because your working capital after 5 years is not going to be valued as much because it's in the future, but you get working capital back after it's done working. So that's what I wanted you guys to understand from that. Going along, we got to find the income for years 1 through 5. So we got to do our revenue, our yearly revenue, minus our yearly costs. So I'm gonna put K, and then we get 110,000. So basically, if we minus revenue minus expense, we get $110,000, which is money we're making per year, net of expenses. So 110,000, and all we gotta do is we gotta add these up. So 110,000. This is also gonna be 110,000. And this is going to be negative $360,000. And I got to multiply these by the present value figures. So for years 1 through 5, we got to look at 5 years on the annuity chart at the 10% discount rate. So that's going to be 3.79. And then we got to look at just the regular present value chart for the year 5 and the year 1. So year 5, I'm looking here, so 10%. So I'm looking 10% of 5 years is going to be 0.621. And then year 0, you just multiply by 1 because that's already in the present. So it's going to be negative 360,000 plus 110,000 times 3.79 plus 110,000 times 0.621. And if I calculate that out, I should get a net present value of 125,320. And that's basically it. So in essence, for this question or any sort of present value question, all you gotta do is you gotta make your chart, your year chart, put the cash flows in their respective years, multiply those cash flows by their discount rates, and then aggregate it all up. And then as I said, sometimes for other questions you might have to make a variable X to solve for that cash flow, because sometimes instead of solving for the net present value, they're making you solve for that cash flow. Finally, to wrap it up, remember for IRR, what you're trying to do is make that initial investment and the cash flows equal each other ultimately. So whatever you invest in, the cash flows that you're using to pay it off, when it's multiplied by that present value annuity figure, should make that investment ultimately 0 for IRR. So there's a little difference between IRR and NPV. So I hope you guys understand that. I know in this last part, honestly, I'm really tired. I'm really tired, and I've been recording these since 5 or 6 hours because I got to do prep work and doing all that stuff, and then I gotta retry certain teaching techniques. And honestly, I didn't feel like this was the best explanation, but hopefully it helped. Hopefully I'm just tired, and maybe my explanation is a lot better when I go edit the videos. And as always, if you guys have extra questions, you can talk to Professor Paz or I or one of the other TAs during office hours. And that's basically it. Hope you guys have a great day, and peace out. On the